So hello everyone, this is a group 5 and we are going to talk about why does a financial institution need to manage risk. So here in this chapter, we are going to talk about 4 types of risk: the credit risk, market risk, liquidity risk, and interest rate risk. So before we go with that, let me tell you first what is a risk. So a risk is a possibility of losing money into a business or in a venture. So even though risk means that you have the possibility of losing money, there is also a saying that if you don't take enough risk, you will not be able to make enough money to meet your investment goals. So how can a firm mitigate the risk? First is by eliminating or avoiding the risk by simple business practices. Second is by transferring the risk to other participants. And third is by actively managing the risk at the firm level. So now let's go with how to eliminate the risk. So there are common risk avoidance activities to be used, like the underwriting standards, which help you set how much debt should be issued, the terms, the interest rates, and also the hedges. You already know what is a hedges. It is the volatility or reducing the volatility to a financial value or financial instruments value. And another one is the diversification and due negligence investigation. So next is how to transfer risk to other participants. So the firm can transfer or substantially reduce the risk by transferring them. So here, there is an example that I said earlier. So the most common way to transfer the risk is through an insurance policy, wherein the insurance carrier assumes the defined risk for the policyholder in exchange for a fee or an insurance premium. So it will cover the cost for the worker injuries and property damage. So that is just an example on how can a firm transfer the risk to other participants. So the third is by actively managing the risk at the firm level. So here, the firm should absorb another class of assets or activities in which the risk is inherent, or it means inborn, natural. Okay, the risk is natural in every firm. Okay, so here in this case, risk management must be aggressive and there must be a good reason for using further resources to manage firm level risk. So we need to focus on what's the problem, what's the risk, and how we are going to manage it.
It is the risk of default on a debt that may arise from borrower failing to make required payments. In the first resort, the risk is that of the lender and includes lost principal and interest, disruption to cash flow, and increased collection costs. The loss may be complete or partial. In an efficient market, higher level of credit risk will be associated with higher borrowers. So, from the term itself, credit, ibig sabihin, ang pagpapautang ng isang lender ay napakalaking risk kasi nawawalan sila ng principal or ng capital plus yung interest pa na pinapatong nila dun sa inutang ng creditor. Then, disruption to cash flow, ibig sabihin disruption ay hindi na masyadong nag-generate yung cash nila kasi nga nasa pautangan. Then, nag-i-increase din yung collection of cost nila kasi nga padami na ng padami yung utang. Tapos yung loss may be complete or partial. Pwedeng kompletong hindi nabayaran or partial lang. Then yung last, higher levels of credit risk will be associated with higher borrowing costs. So meaning, kung ang utang sa iyo ay 500 lang, ibig sabihin hindi siya masyadong big deal sa iyo. Pero kung 500,000 na yung utang sa'yo, edi malaking risk yun. Maaaring magkaroon ka ng loss, napakalaking loss sa iyong company. Second slide, losses can arise in a number of circumstances. Ibig sabihin, ang losses daw ng mga lender ay nakabase sa dami ng circumstances. First, a consumer may fail to make a payment due on a mortgage loan, credit card, or other loan. So, ibig sabihin, yung consumer ay hindi nakapagbayad sa'yo dahil meron pa siyang mortgage loan at iba pang loan sa mga banks institution. So, kumbaga, hindi lang siya may utang sa'yo, meron pa din siyang utang sa iba na nauna niya pang bayaran o mas inobliga niyang unang bayaran kesa sa'yo. Kaya nalaki yung losses niya. Second, a company is unable to repay asset secured fix. So, ibig sabihin ng asset secured fix ay yung paninigurado ng isang lending institution na makakabayad ka sa kanila, na kung kahit hindi ka makabayad ng mismong cash, at least may makukuha silang isang bagay or asset na bilang kapalit nun. Halimbawa, nangutang ka sa bangko ng 1 million, tapos ang nilagay mo na kapalit nun ay yung iyong bahay. So, kung hindi ka makabayad ng 1 million sa due date, kukunin nila yung bahay mo. Next is, a business or consumer does not pay a trade invoice when due. So, ito ay parang notes payable na ikaw yung supplier, tapos nagpautang ka sa kumpanya or sa isang consumer, tapos biglang dumating yung due date na hindi ka nila nabayaran or hindi nila nabayaran yung in-acquired nila na product or services. So yun, magkakaroon ka ng losses. Isa pa, a business does not pay an employee's earned wages when due. So yung wages ay napakalaki ng pagkakaiba sa salary, kasi yung wages is hindi regular yung sahod or hindi ka regular na employee. Samantalang yung salary ay fixed baga. Kumbaga, regular ka na employee at regular din lagi yung sahod mo. So, pag naipon yung wages ng isang employee, mas lalaki yung losses ninyo. Next ay yung a business or government bond insurer does not make a payment on a coupon or principal payment when due. So, katulad din ng mga nauna, nag-due date na yung principal or yung pinakang capital ninyo, pero hindi pa rin nila nababayaran. So, lalaki talaga yung losses. Is an insolvent insurance company does not pay on policy obligation. So, meaning insolvent, hindi na, or wala nang kakayahan magbayad ng mga inutang nila. So, yung insurance company ay hindi na makakabayad sa obligasyon nila sa kumpanya mo. So, yun, magkakaroon ka ng losses. Is an insolvent bank won't return funds to a depositor. So, katulad din siya ng loss. Ang pinagkaiba lang niya is yung bangko ay na-bankrupt. So, ibig sabihin, hindi na nila mababalik yung mga dineposit mo sa kanila kasi nga, nag-declare na sila ng bankruptcy. So, kasi nga mga insolvent na sila. Kaya, magkakaroon o lumalaki yung losses. A government grants bankruptcy protection to an insolvent consumer or business. So, dito parang yung government ay nagbibigay ng protection dun sa mga consumer o mga kumpanya na hindi na kayang magbayad. So, yun. Slide is, a credit risk can be of the following types. Una, credit default risk. The risk of loss arising from a debtor being unlikely to pay its loan obligation in full, or the debtor is more than 90 days past due on any material credit obligation. Default risk may be in fact all credit-sensitive transactions, including loans, securities, and derivatives. So, yung default, ibig sabihin, hindi na sila obligado na bayaran ka, or wala nang chance na bayaran ka. So, or 90 days past due na yung pagbabayad nila. So, kung hindi ka makabayad ng utang nila, maaaring maka-apekto sa transaksyon ng kanilang kumpanya yun. Kasi, paano kung yung perang yun na lang, or yung capital na yun na lang yung umiikot dun sa kumpanya nila? Paano na lang yun? Then, yung securities and derivatives, diba yung derivatives ay yung nagde-derive ng value ng credit. So, kaya siya naaapektuhan. Pangalawa ay concentration risk. The risk associated with any single exposure or group of exposures with the potential to produce large enough losses to threaten a bank or operation. It may arise in the form of single name concentration or industry concentration. So, yung single exposure ay yung pag-i-invest mo sa iisang bangko lang. Yung doon ka lang talaga maglalagay ng pera mo. So, paano kung isang araw mag-bankrupt yung company mo? So, mawawala lahat ng nilagay mo doon. So, maaari pang bumagsak bigla yung company mo dahil sa pag-i-invest mo lang sa isang bangko. Yung last, country risk. The risk of loss arising from a sovereign state freezing foreign currency payment, or when it defaults on its obligation. This type of risk is prominently associated with the country's macroeconomic performance and its political stability. So, yung country risk, ibig sabihin, ay halimbawa, yung isang country ay may utang sa atin. So, dahil sa economic crisis or dahil sa pandemic na na kinakaharap natin ngayon, hindi sila nakakapagbayad. So, yung kahit principal or interest, hindi man lang napapabalik sa atin. Imbis na napapaikot na natin, wala, nai-stack lang sa kanila.
Hi, my name is Marjorie Garilao. I am from Group 5 and I'm the one who is assigned to discuss about liquidity risk. But before we discuss or define what is the word liquidity risk or what is liquidity risk, we must first define what is the meaning of the term liquidity. When we say liquidity, it is the ability of a company or an individual to pay its debt immediately by selling off its asset or resources or securities without suffering any tremendous losses. So, tatagalugin ko lang, ang liquidity daw ay ang kakayahan ng isang kumpanya o ng isang tao na nabayaran agad ang kanyang mga utang or obligation sa pamamagitan ng pagbebenta ng mga asset nang hindi man lang nakakaranas ng pagkalugi. Another shortest and simplest definition of liquidity is, it is the ability of converting asset into cash immediately or quickly. So, that is the meaning of liquidity. So, tapos na po tayong i-define kung ano nga po ang meaning ng liquidity. Kaya pupunta na tayo sa pinakang topic natin, which is liquidity risk. So, what is the meaning of liquidity risk? When we say liquidity risk, ayon dito sa aking definition, ang sabi dito, liquidity risk is the risk that a sudden and unexpected increase in liability withdrawals may require financial institution to liquidate its asset in a very short period of time at a low price. So, yun po ang meaning ng liquidity risk. And i-illustrate ko lang yung ibig sabihin niya. So, meron tayo ditong financial institution at meron din tayo ditong depositors. So, oo nga po pala, sa point of view ni financial institution, kapag sinabi natin liabilities, ito yung pera na dinedeposit ni depositor kay bank or kay financial institution kung saan ginagamit naman ni financial institution yung pera para i-invest sa ibang bagay o para ipautang sa ibang users na nangangailangan ng funds. So, ayun po. Balik tayo. Financial institution, bank, and depositor. Si financial institution daw ay may asset na kung saan meron siyang cash on hand na 5 million pesos. At meron din siyang non-liquid asset na kung saan tinatawag nating building na nagkakahalaga ng sabihin natin 20 million pesos. So, ayun, ito yung story. One day, si depositor is pumunta kay financial institution at sinabi niya kay bank na, bank, kailangan kong mag-withdraw ng 15 million pesos agad-agad as in now na. Siyempre, as a bank, may utang tayo or may liability tayo kay depositor, kailangan nating i-meet yung obligation natin o yung need ni depositor sa atin, which is kailangan niya ng withdrawals na 15 million pesos. So, dahil may cash on hand na si financial institution na 5 million, kailangan na lang niya ng 10 million pesos. So, dahil may non-liquid asset siya na building kung saan nagkakahalaga ng 20 million pesos, yun ang gagamitin niya para makuhaan ng 10 million pesos. So, ang ginawa ni financial institution is binenta niya sa market yung building niya na nagkakahalaga ng 20 million pesos. Ang kaso nga lang, walang buyer ang bumili sa kanyang building. So, dito na papasok ang sinasabi nating liquidity risk. At dahil walang buyer ang bumili sa building ni bank, ang ginawa ni bank is nag-take na siya ng risk. Ang ginawa niya, imbes na 20 million pesos ang price ng building, ang ginawa niya is half of its price or naging 10 million pesos na lang yung building na binebenta niya sa market. Yun yung sinasabi nating liquidity risk. Nag-take niya siya ang ginawa ni bank is nag-take na siya ng risk at nagkaroon na siya ng losses para lamang maibenta or maliquidate yung asset na kinakailangan niya para makakuha ng certain amount of money para sa need ni depositors. Yun po ang tinatawag nating liquidity risk. So, what are the types of liquidity risk? There are two types of liquidity risk. The first one is funding liquidity risk and the second one is market liquidity risk. Punta muna tayo sa funding. When we say funding liquidity risk, ayon dito sa definition, funding liquidity risk is the risk that a financial institution will be unable to pay its debts when they fall due. Sa Tagalog, ang funding liquidity risk daw is yung walang kakayahan ng isang financial institution or isang business na magbayad ng kanyang utang or obligation due to lack of funds. So, yun po ang funding liquidity risk. Punta naman tayo sa market liquidity risk. When we say market liquidity risk is the risk of not being able to sell asset in a timely fashion without having to offer a heavy discount. Yung market liquidity risk is yung example ko kanina sa illustration ko kung saan hindi siya makapag-liquidate or hindi siya makakuha ng funds dahil yung asset na binibenta niya sa market is walang bumibili or walang buyer. So yun po ang market liquidity risk. Two types of liquidity risk, funding liquidity risk and market liquidity risk. When we say funding, cost nito is lack of funds, and when we say market, ang cost naman nito is no buyer. So yun po. How is liquidity risk can be measured? First, punta muna tayo sa funding liquidity risk. Funding liquidity risk can be measured using two liquidity ratio. The first one is current ratio and the second one is quick ratio. Punta muna tayo sa current ratio. Pag sinabi natin current ratio, it measures the ability of how a company pays its current liabilities using its current asset. And the formula for current ratio is equal to current asset divided by current liabilities. So, yun po ang current ratio. And pupunta naman tayo sa quick ratio. This is the formula for quick ratio. Cash plus marketable securities plus accounts receivables is equal to is divided by current liabilities. So, pag sinabi natin quick ratio, it measures how well a company meets its short-term financial obligation by converting short-term marketable asset to cash to cover its short-term marketable liabilities. That is quick ratio. The two types of measurement para sa funding liquidity risk is current ratio and quick ratio. How liquidity risk can be measured? So, tapos na tayo para sa measurement sa funding liquidity risk, kaya pupunta na tayo sa market liquidity risk. Market liquidity risk can be measured in three ways. These three ways are depth, width, and resilience. Pupunta muna tayo sa depth. According dito sa definition natin, the depth of a market is a measure of the volume of securities being traded and the effect that orders have on market price. Ang sabi dito sa depth, kapag daw marami yung shares na binebenta sa market, yung large orders would not have a significant effect on the market price. Pero kapag kokonti lang daw yung mga shares na binebenta sa market, yung large orders would have a significant effect on the market price. So dito sa depth, yung depth, it measures the liquidity in the quantity dimension. So next na tayo. Width. Sabi dito sa definition ulit natin, the width of a market refers to the bid-ask spread. When we say bid-ask spread, ito yung difference between the asking price and the offer price. Ang sabi dito sa width, kapag daw malaki yung gap between sa price na binigay ni sellers at sa price na hinihingi ni buyers is ang possibility nun is mababa ang chance na magkakaroon ng transaction between them. Pero kapag maliit lang daw yung gap between dun sa price na ibinigay ni seller at dun sa price na hinihingi ni buyer, magkakaroon daw talaga ng matik na possibility na magkakaroon ng transaction between them. So, ang with it measures the liquidity in the price dimension. And then last, resilience. According ulit sa ating definition, the resilience of a market refers to the spread at which price returned to previous levels following a large transaction. So, dito sa resilience natin, it measures the liquidity on time dimension naman. So, uulitin lang natin. There are 3 ways in measuring market liquidity risk. The first one is depth. Depth is for measuring liquidity in quantity dimension. The second one is width. It measures the liquidity in the price dimension. And the third one is resilience. It measures the liquidity in the time dimension. So, yun po. Cause of liquidity risk. There are 2 causes of liquidity risk. The first one is liability side reason, and the second one is asset side reason. Pupunta muna tayo kay liability side reason. Pag sinabi nating liability side reason, according dito sa ating definition, it occur when a financial institution liability holder such as depositors or policy holders seek to cash in their financial claims immediately. Ito yung example ko kanina sa kay bank at depositor, kung saan si depositor is biglaang pumunta kay bank para mag-withdraw ng napakalaking halaga ng pera. So, yun yung example natin sa liability side reason. Pupunta na tayo kay asset side reason. According naman ulit sa definition natin dito, asset side reason arises from transaction that result in a transfer of cash to some other asset, such as the exercise of a loan commitment or a line of credit. Dito sa asset side, ito yung halimbawa, diba? Binigyan tayo ng deposit ni depositors, binigyan niya tayo ng funds. And then yung funds is pinautang natin sa ibang users na nangangailangan ng funds. So, one day itong mga nangutang na to is hindi nagbayad nung pinautang natin. Kaya doon nalalabas yung possible risk sa atin. Ito yung example ng asset side reason. So, there are 2 causes of liquidity risk. The first one is liability side reason and asset side reason. How can liquidity risk be managed? So, there are so many ways na ginagamit ng mga financial institution, other businesses, and investors para lamang ma-manage nila yung exposure nila sa liquidity risk. Katulad nito, by forecasting cash flow. Pag sinabi natin forecasting cash flow, ito yung ini-estimate nila kung gaano karami na ba yung perang meron sila at kung magkano pa yung perang marireceive nila in future. Yun yung forecasting cash flow. Ang kasunod pa nito is comparing asset and liabilities. By comparing asset and liabilities, it helps the business or the financial institution to determine how much cash they would generate on a short notice and how much cash they might owe. So, yun. Forecasting cash flow and comparing asset. So, next is creating buffer between earnings and expenses. Mas maganda kung magkakaroon ng mas malaking gap between earnings and expenses. Mas maganda kung mas malaki si earnings kaysa kay expenses kasi mas makakatulong ito para madaling ma-cover or makapag-adjust ang isang financial institution or company para sa mga paparating na unexpected expenses. So, next. Short-term liquid asset investment over long-term illiquid asset. Dito, mas maganda na mag-invest sa mga short-term liquid asset. Bakit? Kasi ang mga short-term liquid asset ay madaling maibenta sa market at mababa ang risk nitong magkaroon ng losses. While kapag long-term illiquid asset, ito kasi is matagal maibenta sa market. Katulad na lang ng example natin kanina sa bank na ang tagal nila bago maibenta yung building. Tapos, sa long-term illiquid asset, mataas ang risk na magkaroon ng losses. Next one is analyzing financial ratio or liquidity ratio. Nakakatulong ito para ma-identify agad natin at malimitahan natin ang exposure natin sa liquidity risk. Next one is reducing leverage. Ang sabi dito, kapag madami ang debt mo or utang, mas malaki yung risk mo na ma-expose sa liquidity risk. Kaya mas mainam na magkaroon ng maliit lang na gap between dun sa amount ng ating asset at sa amount ng ating liabilities. So next is conducting stress test. Mas maganda na mag-conduct din tayo ng mga ganitong test para ma-ready din naman natin yung ating institution or company at para malaman din natin yung mga risk areas kung sakali mang magkaroon ng mga economic problem. At dahil dito din sa mga stress test na ganito, makakatulong ito para makapag-develop tayo ng plan para laban sa mga possible risk na dadating. So next is diversifying investment. Pag sinabi nating diversifying investment, ito yung hindi lang basta mag-i-invest ka sa isang bagay, kundi mag-i-invest ka rin sa iba't ibang uri ng bagay. Example kasi ng risk nito, halimbawa, nag-invest ako sa isang Japanese restaurant. And then itong yung buong money ko, buong funds ko ay ininvest ko sa Japanese restaurant. And then itong Japanese restaurant is hindi tinangkilik dito sa Pilipinas. Ibig sabihin, nalugi. Kasama ng pagkalugi ng Japanese restaurant is nalugi rin ako doon kasi lahat ng investment ko is, lahat ng funds ko ay nilagay ko or ininvest ko doon sa Japanese restaurant. Kaya mas mainam din na mag-invest ka hindi lang sa isang bagay, kundi sa maraming bagay din. So next is gauging potential market. Gauging potential market. Mahirap kasing magbenta ng mga asset on short notice. Katulad yung kanina sa building. Ang tagal bago maibenta ni bank yung kanyang building, kailangan pa niyang magbaba ng price para lang maibenta yung kanyang building. So, dito sa gauging potential markets, bago sana tayo magbenta ng mga asset natin, kailangan muna nating malaman kung ano nga ba yung mga potential market para sa ating asset. Kailangan din nating malaman kung gaano nga ba katagal bago mabenta itong asset natin. At kailangan din nating malaman kung ano ba yung sapat or enough price para sa asset na binebenta natin. So, yan. So, why liquidity risk is important to understand? Ito lang ang sagot dyan. Liquidity risk is important to understand because it helps the financial institution, companies, or other businesses to ensure them that they are always able to meet their financial obligation. So, yun lang po. At dito na po natatapos ang discussion natin sa liquidity risk and thank you sa pakikinig.
Ako po si RJ Diluna at ang nasign sa aking topic ay interest rate risk. So, ano nga ba ang interest rate risk? Ang interest rate risk ay ang risk na maaaring ang investment mo ay bumaba ang value kapag merong bagong investments o bonds na pumasok sa market na may mas mataas na interest rate. Ang example nito ay si Mr. Go na may 1 million pesos na bonds na mayroong maturity na 30 years at fixed rate na 3% or 30,000 per year. Kung i-hold ni Mr. Go ang kanyang investment within 30 years ay makukuha niya ang 1 million pesos kapag nag-mature na ang bonds. Pero meron pa siya isang option na ibenta ang bond sa secondary bond market sa kahit na anong oras. Tapos, ang risk naman dito ay kung ibebenta niya bago mag 30 years ang kanyang bonds ay pwede siyang makakuha ng mas mababa pa sa 1 million na presyo sa secondary market. Let's assume na after 1 year, merong bagong bonds na pumasok sa market na merong 4% interest rate na mas taas kaysa sa 3% interest rate ng bonds ni Mr. Go. Kung kaya't, mas pipili ng buyers ang 4% interest rate ng bagong bonds kaysa sa 3% interest rate ng bonds ni Mr. Go. Kung kaya't, bababa ang value ng bonds ni Mr. Go. Pero, pinagpatuloy pa rin ni Mr. Go ang pag-hold ng kanyang bonds at after 10 years, bumaba ang rate sa 2.5%. Kung kaya't, mas pipiliin na ng mga buyer ang 3% interest rate ng kay Mr. Gong bonds kaysa sa 2.5% rates. Yon ang magpapataas ng value ng bonds ni Mr. Go at mas tataas ang presyo ng kanyang bonds higit sa 1 million sa secondary market. At under naman ang interest rate risk ang refinancing risk. Ang refinancing risk ay ang halaga ng refinancing na mas malaki pa kaysa sa return on asset investment. Halimbawa, meron tayong 100 million liabilities na merong maturity na 1 year para ipinance ang pagbili ng 100 million asset na meron namang maturity ng 2 years. Suppose that merong 9% cost of fund ang financial institution sa year 1 at meron silang return on asset na 10% kada year. So that, pwede silang mag-lock in ng 1 million profit sa year 1. At kung hindi naman magbabago ang interest rate, pwede silang mag-refinance ng kanilang liabilities sa year 2 at magkaroon ulit ng lock ng 1 million na profit. Pero kung tumaas naman ang interest rate sa year 2 at umutang pa rin ang financial institution sa 11% interest rate, magkakaroon sila ng loss na 1 million kung kaya't ma-offset lang ang profit nila noong year 1. Tandaan na kung mas tataas pa sa 2% ang itataas ng interest rate sa year 2 ay magkakaroon ng loss ang financial institution sa buong 2 years. At ang isa pang under ng interest rate risk ay ang reinvestment risk. Ang risk na ito ay ang pagbaba ng return on asset kaysa sa cost of fund. Ipagpalagay natin na merong 9% na cost of fund ang financial institution kada taon at meron silang 10% na return on asset investment sa unang taon. So, pwede silang mag-lock in ng 1 million na profit sa unang taon. At sa pangalawang taon naman, kung bumaba ang interest rate sa 8% at mag-invest pa rin ang financial institution, magkakaroon sila ng loss na 1 million kung kaya't ma-offset lamang ang tubo nila nung unang taon. Ang huling under naman ng interest rate risk ay ang price risk. Ito ay ang risk na pagbago ng presyo ng security kapag ang interest rate ay nagbago.
Hi everyone! Hope you're doing well. In this short lesson, I'm going to focus on one of the type of risk in the financial institutions, which is the market risk. So let's start with the definition of it. Market risk is refers to the risk that an investment may face due to fluctuations in the market. It is also known as systematic risk, which is also referred to the specific currencies or commodity. So, yung risk na tinutukoy dito ay yung pagbaba ng value ng investment. And market risk is contrast with specific risk, which is also known as business risk or unsystematic risk, which is tied directly with the market sectors or the performance of the particular company. In other words, market risk refers to the overall economy, while the specific risk involves only a part. So, there are examples in market risk. Changes in equity prices or commodity prices, interest rate moves, or foreign exchange fluctuations. To elaborate, there are several standard market risk factors, including equity risk, which is the risk that the share price will change,
and it involves in the changing prices in the stock investments. And commodity risk is the likelihood that a commodity price such as copper, coffee, and cereal will change. So it covers the changing prices of commodities. In currency risk, the probability that the foreign exchange rates will change. So it is also called as exchange rate risk. It is arises from the change in the price of one currency in relation to another. Halimbawa, changing in prices of peso to dollar, yung palitan, and for example, investors are firms holding assets in another country. So there are some risks na maaaring mangyari kasi pabago-bago naman yung palitan ng pera. So that is a currency risk. In interest rate risk is the risk that the interest rates will go up or down. So it covers the volatility that may accompany interest rates fluctuations due to the fundamental factors such as central bank announcement referred to the monetary policy, and this risk is most relevant to investment in fixed income securities such as bonds. And inflation risk, which is the risk that overall rises in prices of goods and services will undermine the value of money and probably adversely impact the value of investment. Let's move on to how does the market risk work. Market risk is referred to the systematic risk, and as I said earlier, or non-diversifiable risk. So market risk is comprised as unknown unknowns that occur as a result of everyday life. It is unavoidable in all risky investment, and it can be thought of as the opportunity cost of putting money at risk. So to expand the concept of market risk, so imagine you are buying a car. Then you can purchase a new one with full warranty or a second hand with no warranty. So it depends on which one you can afford and kung alin yung mga features na mahalaga sa'yo at saka kung paano mo siya kayang imaneho or whatever, and your risk tolerance. So as you check out different cars, you find that some makes and models perform better than other. So it also have superior repair histories. However, regardless of what vehicle you eventually decide upon, there are several risks in the road na wala namang kinalaman sa pagkakabili mo doon sa sasakyan, or wala namang kinalaman doon sa sasakyan mong nabili. Pero may impact siya doon sa iyong driving experience. Halimbawa, habang nagdadrive ka, may tumawid bigla na animal sa road. Tapos bigla kang natamaan ng kidlat habang nagdadrive, or biglang nasira yung traffic lights and there is icy roads, at may pagkakataon na makasalamuha ka ng mga smog gangs na habang nasa red lights ka. So those factors might be beyond your control, or hindi mo siya kayang i-control, pero may impact siya dun sa driving experience mo. And let us relate it to the investment. So sa investment, may mga iba't ibang uri or level ng risk sa investment. And in those risks is associated with a specific investment as a marketplace as a whole. So as you build and maintain your portfolio or investment, kailangan natin i-consider na may mga global effects or mga factors na mangyayari pero wala namang kinalaman sa ating investment. Pero malaking impact dun sa ating investment. So, like as I said, mga adversely event na hindi naman natin inaasahan, na hindi naman natin ginusto na mangyari, yun yung mga market risk na kailangan naman nating aware tayo. So, let's move on the other one. Why does market risk matters? Because of the market efficiency, you will not be compensated for the additional risk that arise from failure to diversify your portfolio. This is extremely important to those who may have a large holding of one stocks as part of an employer sponsored incentive plan. So, specific risk exposes you to adverse events on a company or industry level in addition to adverse events on a global or economic level. Now, how to measure market risk? So, to measure market risk, investors and analysts use the value at risk or the VAR method or VAR modeling VAR modeling is a statistical risk management method that quantifies a stock or portfolio's potential loss as well as the probability of the potential loss occurring. So, sabi dito, yung VAR modeling daw ay ginagamit para use potential loss as well as the probability of the potential loss occurring. So, sabi dito, yung VAR modeling daw ay ginagamit para ma-quantify yung mga magiging loss ng investment mo or yung portfolio. So, may isa pang measurement which is the beta. It is measures the volatility or market risk of a security or portfolio in comparison to the market as a whole. Ginagamit ito sa capital asset pricing model para malaman kung ano yung expected return of an asset. So, paano ba mababawasan ang market risk? So, in market risk, there are the best way or the effective way to reduce the market risk is hedging. And under this hedging is the diversification, which is a risk management strategy that mixes a wide variety of investment within a portfolio. So, in diversification, it is said that don't put all your eggs in one basket. And it actually makes sense even in finance. Why? Because diversification is when an investor puts his finance into investment that don't move into a uniform direction. Simply put, it is investing in a variety of assets that are not related to each other, so that if one of these is declines, so the other will rise. For example, a businessman buy a stock from a hotel, private hospitals, and chain of malls. And if the tourism industry, which is the hotel operates, makaharap ng adverse event or negative event, so hindi madadama yung iba mong investment dun sa ibang industry tulad ng mga private hospital kasi hindi sila related to each other. So, that's the diversification. And final thought is hedging is an important protection that investors can protect their investment from sudden and unforeseen changes in financial markets. So, and risk can be reduced to some extent if you diversify your investment. Like as I said, when you diversify your investment, it will reduce the market risk. And however, it is impossible to to eliminate all risks. Some market risks are not possible to prevent or foreseen. Natural disasters such as hurricanes, volcanic eruptions, and earthquakes can strike at any time and may affect the value of your investment. So, yun nga yung sinasabi ko kanina na wala namang kinalaman doon sa investment mo. Nangyari na lang talaga, kaya nagkaroon ng impact at malaking impact sa investment mo. So, other sources of market risk includes terrorist attacks, political instability, recessions, and trade embargoes. So, that's the to reduce the market risk. So, to sum it up, market risk mostly occurs from a bank activities in capital markets. It is due to the unpredictability of equity markets, commodity prices, interest rates, and credit spreads, and banks are more exposed if they are heavily involved in investing in capital markets. So, mas lalo daw na-expose yung mga banks sa risk kapag ito ay about sa investing ng capital markets. Kasi yung mga commodity prices also play a role because bank may be invested in a company and that bank will invest to the companies that commodities are produced, and as the value of the commodity changes, so that's the value of the company. Kagaya ng kanina, kapag daw bigla nagbago yung mga price dun sa company yun, so maapektuhan na rin yung value ng company at yung value ng investment. So, kasi yung mga changes ng commodity nangyayari kapag nangyayari sa supply and demand shifts, which is hard to predict. So, meaning, mahirap i-predict yung mga nangyayari dun sa supply and demand shifts. So, hindi naman natin hawak ang mga maaaring mangyari. So, to decrease market risk, diversification of investment is important, and other ways bank reduce the investment is include hedging their investment with other and inversely related investment. So that's all.